Today we have Bill Holter. Bill Holter is one of the world's renowned experts on precious metals, gold, silver, and he was a retail stockbroker for about 25 years or so and was very much within the Wall Street system. Started to wake up to some unsustainabilities in the economic system, which also and ultimately led him to becoming one of the biggest speakers on gold and creating a healthy monetary system. So I appreciate you joining us. We're going to have a little bit of a different setup than usual because we have Bill way out in the boonies out there in Texas. And so we were able to jerry-rig a system to get this interview going. So I appreciate you joining me, Bill.
Thanks for having me, Jake.
Okay, so let's take a look right now at everything that's going on. We've got gold down today on Tuesday, the day after Memorial Day. We've got stocks up. We've got bits and pieces of the economy reopening. And we've got a lot of people, if the word would be optimistic, or maybe the word is more hopeful, that we're going to see a recovery taking place here. And you're someone who disagrees with that going on. What's your take on everything that we're seeing right now as of Tuesday? What's Bill been thinking about on his horseback ride through probably thousands of acres out in Texas? What have you been thinking about?
Well, it's funny you asked that question. I wrote an article, I think it was either Saturday or Sunday. I titled it, "Are You an Idiot?" Again. And the gist of the article was, 5 or 6 weeks ago, there were people contacting me left and right, asking me what's going on, asking me for advice. But these are the same people who, prior to that, for years, said, the things I've said about credit and the overuse of credit, I was an idiot. And now that the market has come back, and of course the market was going to come back some with literally trillions of dollars pumped into the system, now, again, I'm an idiot. To answer your question, let's just look at shopping. Let's look at malls. Malls across the United States, they haven't made any payments in 2 months. That debt is broken, and I don't think you're going to see consumers go running back to malls anytime soon. You've got Macy's, you've got JCPenney's, you've got Sears, you've got all these big retailers that are bankrupting, and they signed long-term leases. So that's going to totally impair the mall business, and that's just one business. I mean, what about casinos? What about cruise ships? What about airlines? What about all kinds of industries? All of these industries have huge amounts of debt, and as it turns out, it looks like they can't go a month or 2 months without any income because they were playing it that close or that tight, their cash flow versus what they owed. So I mean, this is it's a nuclear debt bomb that's already detonated, and there's no putting the genie back in the bottle.
Okay, so what do you think then they're doing? Do you think that the Treasury knows this, Powell knows this, and Trump knows this, and they're just seeing if they can kick the can down the road another 10 years? Or what do you think's going on? Obviously, your partner, Jim Sinclair, is from the Siegelman family and original part of the banks and financial systems. And when you guys are talking, and I'm sure he has some pretty interesting people that you guys are speaking to behind the scenes, what do you think what Jim calls the financial geniuses are thinking right now about what they're doing here?
Well, I think you've got 2, maybe 3 sets of, quote, financial geniuses. And I think pretty much all of them know that there's a huge, huge problem. The very top tier of the financial geniuses knew this was coming, and I mean, the argument could be made going back to 1913 when the Fed was initially created, that where we are today is exactly where they knew we were going to be, and they knew it would be a total collapse. I said for years that because of the credit, the overuse of credit in the system, that at some point in time, debt or cash flows would not be able to service the debt, and they would have to literally kick the table over, whether it be war or what have you. Did I know it was going to be coronavirus or some type of health scare? No. But it serves the purpose that the very top tier can, or the second tier can say, our plans were working, everything was fine, but along came XYZ, and in this case, XYZ happened to be coronavirus. The only problem with that is 5 months prior to, or 4 months prior to the very first cases of coronavirus, on September 16th of last year, the repo market blew up overnight. It went from roughly 1% to 10% in one night. And from that evening forward, every single close of business, the Fed had to pump billions into the repo market in order to keep that under control. So what I'm getting at is the credit market had already started to blow up. One other thing, if you look at the economic reporting, you can't really look at one country. You can't look at one country because the numbers are easy to fudge. But if you look at trade numbers, that's got 2 countries involved, or 30 countries involved, or 100 countries involved. It's a zero-sum game. It has to add up. It has to zero out in the end. So if somebody's lying about their trade numbers, then the numbers don't add up. And if you look at the trade numbers from the last half of the last quarter of last year, trade, without a doubt, had already started to turn down. So the recession / now it's a depression that we're in currently had already started long before coronavirus.
So, first of all, for people, so the repo market is the overnight lending market between banks. And that's important for the system because we have a credit-based system, and the way it relies on is one bank giving another bank money to make loans, and then the other bank pays them back. And it's just like this paddle. It's like a ping pong back and forth. Is that an accurate way for someone like myself to saying, what exactly is that? Just in a really brief summary.
Yes, but it's not only between banks.
Okay.
You do have commercial paper in there, and a part of the repo market is to carry inventory overnight. And when you think of inventory, you're thinking of a retailer or something like that. Not just that type of carrying overnight. It's carrying financial assets overnight. Brokers, hedge funds, etc., hit the repo market in order to borrow funds to carry positions overnight.
Okay. And in an interview in July of 2019, you said, and I'll cut the clip in here, a brief clip of it, maybe if I can use it for, depends on copyright stuff. But what I found interesting as I was preparing for this interview was in July 2019, you did an interview, I believe it was with Greg Hunter, but it could have been with someone else. And you said, look, the trade is slowing right now and the credit market is starting to break right now. This was July 2019, so before coronavirus. And you said, quote, I'm expecting a false flag here in the next few months or else the credit market is going to implode. And so shortly thereafter, a few months later, we started the repo setup, and now we're in this situation right now where we've now pumped trillions of dollars into the market.
Yeah, that's exactly where we stood. And when I was saying that they needed a false flag, what I was saying was the Fed was going to have to step up and literally pump unlimited amounts of funds into the system. Otherwise, credit was going to blow up. And that's pretty much where we were when repo started on September 16th, and then even to a greater extent back in March when they started with, we're doing 3 trillion here and 2 trillion there and another trillion here and, trillions all over the place. So, whether coronavirus is man-made or it's natural, I don't know, but we'll use the word fortuitous.
Yeah.
It came along at the time because it allowed the Fed, it allowed the Treasury to pump unlimited funds into the system. And if you go back to 2008, think about how hard it was to get Congress to agree to pump $700 billion into the system. And this time, everybody's like, oh, please save us. Spend as much as you can, as much as needed.
So you thought that the system was going to go down last time. Is it possible that you have a cognitive bias based off of cold, hard facts, and the system is so irrational and we're underestimating what infinite money printing can do, and that they're going to be able to keep this afloat?
I wouldn't call it a bias. I would just call it math. The math says that there's no way. I can't tell you when. I can't say it's tomorrow or next month or even next year. But looking at it from a purely mathematical standpoint, first off, there's more debt in the system than can ever be paid off. And the problem with creating more liquidity means you've got to create more debt. So the debt bubble gets bigger and bigger and bigger. And what happened with the shutdown is that it shut down cash flows. And once cash flows got shut down or tightened down, they were already struggling to make the debt service month after month, but then with the cash flows much lower, it's an insolvency. It's an insolvency issue. So can they do it forever? No, they can't. And the other side of that equation is if they keep printing currency forever, what does that do to the currency? And you can see that in the price of gold. I mean, that's why gold is up, 50% in the last 12, 18 months, because all currencies are weakening across the board.
So here's what somebody that doesn't agree, they would argue, well, look at how strong the dollar is. That's what they're saying on mainstream, right? So can you give your opinion on that? Because that's the next, quote, logical step someone would say in response to you. Well, you're not understanding. Look at King Dollar.
Well, it's a totally bogus argument because the DXY index, it's currencies measuring themselves against other currencies. So if you're looking at the dollar index with the dollar close to par and, up from the 70s and 80s, yeah, the dollar has gotten stronger versus the euro, versus the yen, versus the British pound, the ruble, the yuan, etc. The dollar has gotten stronger versus foreign currencies, and I can get into why in a nutshell, because trade has been denominated in dollars. If you go back to Richard Russell's synthetic short, the dollar theory, that since trade has been done in dollars, in order to settle trade or to settle borrowed money in dollars, the dollars have to be bought. So versus other currencies, that's absolutely true. The dollar is strong. But let's look at it versus gold. A year ago, gold was $1,300 or in that neighborhood. Now it's $1,700. You're looking at a 30% drop in the dollar. Most people would say gold went up, but the reality is the value of the dollar went down versus gold. Gold is the standard. The dollar is not the standard. Gold is the ruler or the measuring stick. The dollar is not. The dollar is elastic. 1 ounce of gold today was an ounce of gold 2,000 years ago, 1,000 years ago, and will still be an ounce of gold 100 or 1,000 years from now. So an ounce of gold never changes. It's the currencies that change. And that's why it appears the price of gold goes up and down.
So I want to talk a bit about the monetary reset and your thoughts on that. But as you've discussed a bit about gold, and you have what people would say is some quite wild predictions of where you think the price of gold will go. Although you aren't pulling the numbers out of the sky again, they're based off of math and they're based off of the debt the United States has. Let me say a first argument that people have made to me, and especially when I've showed them your work, they say, well, first of all, let's address the first part. There's a lot of people, and I'm sure you know a lot of them, that have been big advocates on gold over the last while, but they become disheartened because the price is so manipulated. If they can print infinite money, can't they suppress the price of gold forever?
Uh, Bluntly, no, they can't suppress the price forever because they cannot print physical gold. I mean, if they could print gold, then, gold wouldn't have value. But they print paper. Paper gets sold on COMEX. It gets sold on the LBMA. But delivery is the issue. And I've talked about this for years. At some point in time, mathematically, there's going to be a delivery failure. And once gold or silver fails to deliver, the entire financial system blows up, because what that shows is that the entire system is fractional reserve.
So,
and Jake, let me just mention the number that I came up with a year and a half ago of $87,000 per ounce. That is an easy number to come up with. You take the amount of gold that the U.S. supposedly hasn't been audited since 1956, but we're told we have it. You take that number and you divide it by just the on-books debt.
right.
You don't add in any pension plans. You don't add in Ginnie Mae, Fannie Mae, Freddie Mac. You don't add in the $23 trillion that looks to have been stolen. You just use and I used the number of $21 trillion. Now we're over $25 trillion. But at $21 trillion, in order to pay that debt off, if it was to be denominated in gold, the price of gold would have to be $87,000 per ounce. So I'm not predicting $87,000 an ounce, but what I'm saying is that's the mathematical number, and I think when all is said and done, $87,000 an ounce is probably going to end up being a very low number.
Right. So just so somebody understands, right? Because I've heard people spout big numbers, but they don't do it with any logical reasoning. You're doing it based off of, if you had a simple T chart of a balance sheet, and on one side you had 25 trillion in debt, and on the other side you had the United States assets, which is basically nothing. One of the only assets that we know of is the supposed like 8,400 tons of gold or whatever. And you're saying to make an even balance sheet, you are doing the math on how many ounces of gold the U.S. supposedly has, dividing it by the debt to create a neutral balance sheet. That's what you're doing.
Exactly. If gold was required to balance the balance sheet of the U.S. Treasury, and this was when the number was at 21 trillion, gold would have to be $87,000 an ounce. And you mentioned the biggest asset on the Treasury balance sheet. If I'm not mistaken, the biggest asset on the balance sheet is student loan debt.
I was about to say that.
So I beat you too.
Maybe we'll cancel out the national debt with student loan.
Well, it's not like this really got anything for their borrowed money anyway.
Yeah, I wouldn't know because I didn't finish, as I told you. So, all right. So when this argument happens, what people say back is, well, there's so many ramifications for a higher price of gold. And people will say, well, if China and Russia own so much, why would the U.S. even let the price of gold raise? Because the higher the price of gold raises, the more power Russia and China have, because they buy so much. For people that are unaware of that, they supposedly have so much gold, and they publish some of those metrics that we can look at. But the next argument that somebody makes back to me, especially when I show them your work, is they say, well, okay, I understand the rationale behind it, but it's still ridiculous. Here's my next argument, which is if the price of gold gets high, then you're giving all the power to Russia and China, who have accumulated so much, so therefore the U.S. won't even let that happen anyways.
Well, let me respond by saying that's a really dumb response. How, if Russia and China own gold, how is the U.S. going to mandate to Russia or China what the price of gold is? First off, it's fighting Mother Nature, but secondly, it's fighting two trading partners that if they want to trade gold at $50,000 an ounce, and Jim has often said, they could bring the price of gold up to $50,000 an ounce, 50,000 bid, 50,000 offered. What do you want to do? You want to buy or sell? And the U.S. has absolutely zero way to stop that from happening. So, that's a dumb response.
Okay, understood. So you talk a lot about the monetary reset, and maybe it's also become a more popular phrase in recent time. Could you please elaborate on what the monetary reset means to you and all those types of things?
Well, first off, we were talking about reset 5, 6, 7 years ago, and we were called conspiracy theorists, tinfoil hat society, whatever you want to call it. And it was back in, I'm going to say 2018, definitely last year, and certainly now. How many people on mainstream media use the term monetary reset? It's used all the time now.
Yeah.
It's commonplace. I didn't get any phone calls or emails saying, I'm sorry I called you an idiot. You were right. I haven't gotten a single, none of that. But we were whacked out 5, 6, 7, 8 years ago when we talked about reset. We were told it could never happen. It has to happen because things have gotten so lopsided and so out of whack. Basically, what a monetary reset does is it brings prices of currencies, it brings prices of goods, it brings things back into if you want to call it normalization. It brings currencies that are too high get knocked down, currencies that are too low. The reset will primarily be against the price of gold. So what you're looking at is you're going to see currencies across the board lose purchasing power. And that's going to be called inflation. Because a cup of coffee is not going to devalue. A bag of rice is not going to devalue. A gallon of gas, yeah, you've seen that drop, but it's not going to devalue. They're not going to pay you to go into a gas station to fill up your car. The point being, the currencies have been overprinted. There's too much debt. Look in the real estate sector. The reason prices got to where they got to is because people were able to borrow to make purchase. And each time somebody borrowed and made purchase, it took real estate off the market. The price went higher and higher. It got to the point where things made no sense at all. For instance, real estate, there's like no real estate in the world that can carry itself with cash flow. It's the greater fool theory. You look at the stock market. The stock market now down 5,000 points on the Dow is way more overvalued today than it was 3 or 4 months ago before the coronavirus, because PE ratios are higher, price to book is higher. The whole idea about reset is prices are going to have to be reset back to within a realm of reality, if you will. And we believe that there's going to be 2 resets. We think the first reset will be man-made, and it will not go far enough, and it'll break. You'll see another panic in the stock market, the bond market, the credit markets. And actually, I think this time around, you're going to see a massive panic in the sovereign debt market. But the second reset, that will be done by Mother Nature. In other words, water is going to seek its own level on the second reset because the first reset didn't go far enough or didn't cover enough ground. So it'll be a two reset process, and it may happen quickly. It may take 6 months, year and a half, 2 years between reset 1 and reset 2. But don't be surprised if it only takes a month or two before the markets rebel and you're looking at game over. And a full reset basically means that all assets, everything, anything that has value on the planet will be reset and seek its value versus other assets.
So when you talk about, let's talk about this first reset. Do you think, is your opinion that behind the scenes right now, the monetary elite, from the Treasury to the Fed to the IMF to the top G20 countries, that they're negotiating something, or is it that they're waiting until they're hoping that things will rebound and they won't need to do anything and they'll deal with it if there's a total collapse? How do you think this is being? Is this a conscious decision that's being strategized right now? What do you think?
I believe that this has been talked about for many years, probably really close to 20 years. I mean, you could go back to, for example, Judy Shelton back in the mid-2000s. Judy Shelton is up for a Federal Reserve Board seat. She talked about $10,000 gold back then, and she talked about the SDR from the IMF, the SDR being the trade settlement unit, replacing the dollar. So, I mean, this has been talked about for a long time. I'm sure it's been negotiated on, is being negotiated on. When they spring the lever or the trap, I don't know. But I think this has been in the works for many, many years. But understand, remember, I just mentioned they talked about the SDR. I don't know whether it's going to be the SDR as the trade settlement unit, but it'll be something man-made. Reset 1 is man-made. Reset 2 is Mother Nature. And man-made is not going to work. So
when we're talking about the SDR, which essentially is another fiat, for people that are unaware, it's what it is essentially it's another fiat currency that is basically a basket of all the other currencies, is really what it is. It's a fiat currency backed by all the other fiat currencies is the best way to describe it. So what if that's the case, if there's just a rollover into a new fiat, why would they even want to make the price of gold go up?
Okay, just to go back, I wanted to point out that the SDR can only be traded between sovereigns.
Oh.
So the SDR is not like, yes, it is a basket. It's a basket of currencies, and it does include gold.
Okay.
Gold is not a currency. Gold is a money, and according to the BIS, it is now a Tier 1 currency. And I think that's important because the BIS knows exactly where this is going.
Bank of International Settlement?
Correct. Yes. So, yeah, the SDR is a basket of currencies, and it does include gold. And are we still up? Can you still hear me?
Yep.
Oh, okay. Sorry, I heard a weird noise out of my computer.
I did too, but you're still on.
Okay. The SDR is a basket of currencies. It does include gold, and the IMF claims, I forget what the number is, I think it's, I may be wrong on this, I think they claim to have 1,700 tons of gold. And if I recall, this is many years back. This is 2005 or 6 or something like that. The IMF said they were going to sell 200 tons of gold, and it was immediately snapped up by India. I mean, when any type of size like that gets offered, a sovereign will step up and eat it up immediately.
Because that's what some people have. I've sent your stuff around to a lot of people, and one of the arguments somebody said was, none of that will ever happen because there's so much gold in hiding that they'll release onto the market to continue to suppress the price.
From where?
I don't know. That's just what I'm being the middleman.
Well, I mean, first off, the question is from where? And then you look at the supply and the demand numbers. And, well, just look at the exchange for physicals that went last year through London. It was over, I think it was 6,700 tons. I mean, global supply is what? China and Russia, global supply is only 2,700 tons per year. I mean, there are no stashes of 6,000 plus tons of gold that London could have even supplied that with. It's a complete fraud. It's bogus. It's fraudulent. And there was, I think the number was, I know it was over 2 billion ounces of silver were EFP'd last year. And total global production is like, what, 800 million ounces? I mean, there are no 2 billion ounce tranches of silver just laying around waiting to deliver on people. I mean, they have, and they are creating more credit and more currency, paper, on a daily basis, monthly basis, annual basis. I mean, they can create it for free. They're creating it for free. And there's absolutely no way that physical supply can keep up with as fast as they're printing. So if that's somebody's argument, well, you're entitled to your opinion, but it's wrong.
So, all right, let me ask you this. So when we're talking about the reset and we're talking about the first phase of it, so if hypothetically the countries were doing their trade settlements in SDRs, what would we be using? Would we just have some type of we'd either have a dollar or some type of a quote unquote like federally approved cryptocurrency that we would trade in? How do you foresee the future of economics in that regard?
If the world were to go to an SDR settlement, then we would have to go to SDRs also.
Okay.
And I mean, nations would be allocated SDRs based on the concentration of the currency in the SDR. I mean, I don't even know what the formula is, but nations across the globe would have access to SDRs. You're asking about cryptocurrencies. I think that's ultimately where central banks are going to go, is that pretty much all currencies issued will be cryptocurrencies, but not the cryptocurrencies you know now, not Bitcoin, Ethereum. What you're going to see is cryptocurrencies issued by China, by Russia, by the United States. And think about why. The reason why is that they can track everything. They can track everything down to a pack of bubble gum. If everything has to be spent that way, they can track absolutely every purchase, every sale, every transaction you make. And isn't that the goal of the globalists?
Yeah, absolutely. So what's your advice to the average 20-something, 30-something, 40-something-year-old that is listening to this and they say, wow, it's, this is interesting. I guess we'll see whether you're right or not in the future, but this is interesting. And somebody who says, I do agree, we're in a very bad financial position. What advice do you have? I'm subscribed to your paid membership, and you were talking about wealth. And, what I talk a lot about and what I try to really encourage people to do is to start a business, especially one that, is obviously something that can navigate these types of waters. And I think, to me, there's a few phases of things that we could all do to prepare. Number one is to get a business. Obviously, this is beneficial for a lot of reasons. One, we aren't at effect to the changes that are happening into the economy. Two, we have optionality and freedom. Three, we have the ability to significantly increase our income because it's not set by somebody else. So I say business. I talk about then I talk about precious metals and things like that. How do you think that the average person should be preparing and can prepare accordingly for preserving their wealth and making sure they don't slip? Because it's clear the middle class is falling apart. Top percent's getting richer, and most everyone else is getting significantly poorer. They don't notice it yet because unemployment benefits, I think, last 10 months when you add in all the federal and state ones. So they don't significantly notice it yet. But what's your advice?
You mentioned unemployment at the end. Unemployment will eventually run out. I mean, universal basic income, it runs out because the currency runs out. My advice basically is don't work for nothing. If you're saving in dollars, if you're saving in euros, if you're saving in yen, pounds, Canadian dollars, what have you, you're saving in something that's going to blow away. You're saving in something that will lose purchasing power. You want to save in something that your labor does not get depreciated over time. So the way to do that is to purchase gold, purchase silver, purchase mining shares of companies that have big reserves in the ground. They will be revalued higher. So in that instance, your labor, your capital will be revalued higher. Other advice would be do not live in a metropolitan area, because when this goes down, it's going to be absolute zoo within cities. And you'll have no idea which direction the danger is coming from. You won't know who's friend or who's foe. You want to be in a smaller community, preferably outside of a smaller community. You need to be able to feed yourself. Now, whether that means farming or stocking up on food or beginning connections with farmers for a source of food, you need to you can't live if you can't eat. You need to be able to purify water. It'd be a good idea to have some type of alternative system to generate electricity. You also need arms. You need guns and ammo. You need guns to hunt, and hopefully you won't, but you more than likely will if you're close to cities. You're going to need guns to protect what you have and to protect your family. Really get back to think of it like it's 1910 or 1920, and the telephone and electricity are brand new things, and people at that point, the biggest difference between the 1929 crash and what we're going into right now is that back then you had a sense of community. You still had a very large percentage of the population were agrarian, farmers, ranchers, what have you. They could live off the land. Today, it's you got to go to the grocery store. It's a different world. It's a different mindset. Neighbors don't know neighbors, whereas in the 1930s, neighbors helped unfortunate neighbors. And in today's world, the unfortunate neighbors are just going to get walked on, stepped on, and all their stuff taken.
So I want to ask you about gold and silver stocks, but before I get there, here I need to respond for what some people are going to, when you talk like that, right? So some people are going to say, you are significantly overreacting. And even if there's a financial situation, they'll just put a new currency in place and everything will be okay. We have enough food. We haven't, that's a response. So say you're overreacting.
Jake, it's not an overreaction because people don't understand that the use of credit is involved in everything, whether it be a loaf of bread, whether it be coffee beans, whether it be the electricity that you use to light your house, the gasoline you use to put in your car. Credit is used in every facet of your life. And what I'm telling you is this is a credit problem. It's a solvency problem. It's not a liquidity problem. It's a solvency problem. And when credit breaks, the things that people have come to believe are an everyday right to humanity, if you will, they're not going to make it to market because everything relies on credit. And very importantly, distribution relies on credit. I mean, the trucking industry, the rail industry, products are not going to move without credit.
Okay, so then somebody says, well, why won't the Federal Reserve and the government just print $100 trillion and go give it to everyone to make sure that those types of breakdowns don't happen?
So if they print $100 trillion, what does the existing $100 trillion that's out there? It makes the existing $100 trillion worth half, right?
Right.
If you double the money, it makes what's out there, what you're doing is you're watering down the currency. That ultimately is inflation and will become hyperinflation.
Right. It makes sense to me. I'm playing that so people, because it's deep stuff you're talking about, and obviously it's very emotional and controversial to people, and that's why I want to touch on those things. I mean, these were all the things that this is why I dropped out of school was, people thought I was insane. But so let's talk a little bit about gold, gold and physical silver, self-explanatory. Everyone that the mentors that I've had have all said, if you're going to invest into gold and silver stocks, always start with a base of real money, which is physical gold and physical silver. So let's assume that's had, and now we're talking about gold stocks. What do you like? Do you like royalty companies? Do you like major companies like Barrick and Newmont? Do you like really small players? What do you like?
Royalty companies have done the best since 2011, 2012 top. The royalties have been the best performers. Myself, I'm a property guy. In other words, I want to own properties that either have large deposits or looks like they have a very good chance of not discovering but furthering the discovery of existing gold in the ground. As I said, I'm a property guy. I want gold in the ground. If I'm going to look at an explorer, it's not a bad idea to have that property pretty close, if not contiguous to a major. It needs to. The best place to find gold is where they already found gold. So if you have a big mine next door, or you're between two big mines, or it used to be a mine and at $300, $400 an ounce it wasn't profitable, but it would be profitable now. Those are the types of situations I would look for, is look for good properties. Now that said, the average person, I would suggest, if you're looking to put X amount of dollars into mining shares, I'd probably take 80% of that and split it between 2 or 3 mining or gold, silver mutual funds. Let a professional manage that money for you. If you want to take 10 or 20% of that earmarked money and do your research and look for properties and obviously, you don't have to be a property person. You could say, well, I want a major that's producing, or I want a royalty company because I want to get some income out of it. If you want to take 10 or 20% and do your own research and figure out where exactly you want to land, that's fine. But my advice would be let professionals manage it with an open-end mutual fund. And I think there's only about 20 to pick from, so it's pretty easy to compare the various mutual funds, and you can see what they actually hold and where they're geographically diversified, whether they're mostly majors, juniors, etc.
That's good advice. What's some of your favorite holdings?
I'm no longer an investment advisor, so I'm not going to name individual names.
Understood.
I will tell you, my business partner is Jim Sinclair. He's the CEO of TRX, and I do have an interest in that. That's publicly known.
So I'm up on my part. I do all my own. I don't do any funds. I pick individual stocks, but I'm also, doing it all the time and spending a lot of time. And I'm up a lot on my portfolio this year. I mean, a lot. And little pullback obviously today with a dip. Can you explain why, for somebody that understands the thesis that you've made, maybe they disagree with some of the things, or maybe they're just hoping you've overstated some things, but in general, they understand the thesis that you're making, and they understand how some level of an allocation to gold might be beneficial for them. It's going to vary for everyone on their allocation based off of their belief in the things that we're discussing. But can you explain why the gold stocks have an attraction, and why, as I said earlier, I'm up a lot. Can you explain why that is, and why they're attractive in a nutshell?
Yeah, that's very simple. Mining companies have what is called operating leverage, and in other words, as the price of gold moves higher, the earnings of a company that has gold in the ground and or is producing, the gold in the ground becomes worth more, and also the production becomes worth more, but it becomes worth more on a either geometric or exponential basis. In other words, let's look at it this way. Let's say you've got a mining company that has a cost of production of $1,000 an ounce, and the price of gold is $1,100. So they're going to make $1,100. They're going to make $100 per ounce. But if the price only goes up less than 10% to $1,200, now that mining company is earning $200 an ounce because they're selling it at $1,200, and their cost to produce is $1,000, and so on and so forth. So you can look at a company that breaks even at $1,000 an ounce, and the price of gold goes to $2,000 an ounce. The holder of physical gold only doubled his money, and technically that was an infinite rise in earnings for the company because they went from zero to whatever the number was. So there's operating leverage. I hope that explains it.
Yeah, exactly. If a company's making it at $1,000 and the price of gold goes to 3,000, and you're still mining 2 million ounces, all of a sudden, without having to do anything else, you have a significant increase in your net profit. So let me ask you, kind of in conclusion here, when you are thinking about everything, and you and Jim are talking, and you're talking to the rest of your think tank types of folks that you interact with, what are some of the things you're looking at right now presently, that you're keeping an eye on presently?
I think the biggest thing to keep an eye on is credit. I mean, you watch the overnight rates, watch LIBOR rates. I think our group is pretty much in agreement that this is going to end up as a a sovereign debt crisis. And what I'm talking about are the debt issued by treasuries of sovereign nations. That's where the next big panic is going to be. And that will also spill over into the Forex markets. So, I mean, you can watch the dollar-euro cross. You can watch the crosses in the foreign exchanges, but also watch what's going on in the sovereign treasury markets. I would suspect it will only take one failed auction of a major. And actually, if you look at the U.S. right now, who's the buyer? Basically, the only buyer left now is the Fed. So we're at the point now where they're the buyer of last resort.
And do you think that this is going to basically, this is just going to keep going until there's some type of an implosion between, that the Fed is just going to keep buying and buying and buying and buying right now until there's some type of a hiccup that can't be corrected?
Well, yeah, I think the Fed and Treasury are now one, and yeah, I think the Fed is going to outright monetize. Whether something snaps overnight or whether you start to see it in the dollar itself, the purchasing power of the dollar versus foreign currencies, I don't know. But you will see it over time. You will definitely see it in the price of gold and silver. You will see the dollar and other foreign currencies devaluing rapidly versus gold and silver. And it would not surprise me to wake up on a Monday morning and find out that there was a failure to deliver somewhere in the world, and that somewhere will be the spark that lights this whole bonfire.
So why don't we get Bill Holter and Jim Sinclair to go out and place a bid for some extraordinary amount of delivery and pop the COMEX?
Would you really want to be the guy who ended the world financially?
Say that again, you cut out.
I said, do you personally, I mean, if you had the ability to do it, would you do it? Do you want to be the person to end the world financially? And it wouldn't take that much. I think it would definitely take less in silver. I think you could do a complete blow up of the silver market with less than $5 billion. And I think probably 10, maybe just a little more than 10 billion in gold. If you went and bid for gold, you'd clean the streets across the entire globe. And you'd create a failure to deliver. And I mean, $10 billion is not even ham sandwich money today.
Who owns most of the gold between China, excluding the IMF, China, Russia, USA, France, Germany? Who owns most of the rest of the gold?
Well, that answer would be India.
Oh, if you exclude India too. My point was, if you exclude a few of those countries, who owns the rest of the gold?
You have individuals throughout the world that own gold. I mean, those are the official sources that you named. The unofficial sources, you are starting to see some hedge funds foray into the physical gold market. And unfortunately, a lot of the hedge funds over the years have done it through GLD, which I think is a big mistake.
Right, and you're seeing, what's his face? Jeffrey Gundlach's been talking a lot about that recently. Obviously a billionaire hedge fund saying stay away from that thing. Fascinating. So, how do you keep a for a lot of people, this interview it'll probably scare them a little bit. Obviously, it's a lot of emotions. There's highs and lows when you really pull the curtain back on the financial system, because it's quite alarming. I know you ride horses. How do you? It sounds like you get yourself outside and things like that. How do you find some peace and balance and joy with so much volatility and things that are quite frankly, they're disgusting to learn. I mean, there's a lot of people that should be in jail, but they never will be. How do you find peace and stability in it all?
off, I've come at this from 100 different angles to try to prove myself wrong, and it's about math. It's about logic. This is not, I'm not waving my arms saying, the end of the world is near, the end of the world is here. I've tried over the years to state facts, back the facts up, and back the facts up with math. And because I've come at this from every devil's advocate standpoint that I possibly could, I'm comfortable that I will be right. And I mean, over the years, I have been right, made some good calls. Back in 1987, I was buying, when I was as a retail broker, I was buying 30-year zero coupon treasuries. And people were saying, you're crazy, rates are going to go up. And what the problem with rates going up is we were just starting to get to the point where debt was becoming a problem, and higher debt was going to pop the real estate market. I retired at 46 years old and left the country prior to 2008. And people said I was nuts to do that, that was just totally overboard. The point being, I've looked at this as I've looked at other things from a logic, from a mathematics standpoint, and I know this is going to happen. I know that the debt bubble, the biggest debt bubble in the history of history, it's going to blow. I can't tell you when, I can't tell you exactly what the spark will be, but I can tell you the debt bubble is going to blow. So, knowing that the debt bubble is going to blow, you want something that does not have liability, because everything in the world has liability, except for gold and silver. Gold and silver are no one's liability. Gold and silver are pure money, not issued, can't be devalued. They're not issued by a central bank, so they don't carry another one's liability. So just from a logic standpoint, I'm comfortable. From a personal standpoint, I ride a horse for anywhere from an hour to sometimes 2-3 hours a day. My horse is Spanish, so I speak to him in Spanish. It's for me, that's solace, just out in the woods riding a horse. So that keeps me even keel.
Awesome. Very interesting guy you are, Bill. I appreciate what you're doing, and I know you've probably gotten a lot of slack over the years, and outside of your personal opinions and predictions, I always appreciate somebody that is willing to say what they feel is accurate, and say what they feel is in the best interest of everybody to know, even when basically every single person is telling you you're wrong, you're stupid. Obviously you don't have that because you've attracted a certain type of community that wants to learn from you. But I'm always inspired by, no matter what people have to say, I always find it empowering to see people that are confident in what they're saying, even if people don't want to hear it.
You can only do the best you can. That's all you can do.